Okay. So, Utkarsh, can you share me your background?
Yeah, sure, sure. So actually, I'm currently a data science student at IIT Madras. I mean, I finished my degree and I teach at other edtech startups. So that's what I do. And I had a minor in finance, so I was planning to do FRM. And that's how, last time last year I had one subject. So I came across a put call parity video, and then I had access to other videos on your channel also. So that's how came across your channel.
Okay, fair enough. So you have how many years of work experience all put together?
I am working up till this point of time. I'm having 1.5 full time.
One 1.5, and you're from IIT Madras, right?
Yes, I did. I mean, two degrees. So this IT Madras degree is the online one. It's hybrid. We study online and we give exams in person at the exam centers, TCS exam centers.
Yeah.
My BTech was from Delhi Technological University in mechanical engineering.
Okay. So from and you're working as data scientist as of now.
Yeah, data analyst.
All right. So fair enough. Let's start off. So first is that why I wanted to have this session is that after uh, getting you know inquiries and trying to understand the how the market is actually panning out as far as the charter exams are concerned, whether it is CFA, FRM, CAIA, the three most popular exams. So I could see that, of course, this is a competitive exam. Sure, it is. And the for the right kind of candidates, and that is within quotes, for the right kind of candidates, of course, sky is the limit, and of course, the market is definitely fertile. But what I see is that the way most of the prep providers or the way most of the students, even when they study on their own, perhaps there is a lot of scope of improvement in that area. So with that thing in mind, I actually charted out this course syllabi. So my approach is going to be a little bit different, but of course, at the same time, the idea is that it should be palatable. It's just not should be for the sake of, you should not take any subject only from the point of view, see any subject only from the point of view of exam. That's been my whole perspective, because once you do that, it would seem like a burden, and it's very difficult to carry a burden for 4 months or 5 months of preparation. So the bottom line is that you must find a way to actually enjoy that subject, enjoy the journey, because as I said, the journey should be more enjoyable than the destination itself. Then only the destination gives a meaning. So without much ado, let me first start with the derivatives as we have promised. So is my screen visible? Is my screen visible?
Yeah.
Okay. So we also have Murali joining us, Anusha joining us. Uh, so Murali, of course, I know. Anusha, will you introduce yourself a little bit? Anusha?
Yeah, hello, I am Manusha. I am currently working in one bank as a on credit pro portfolio. I was connected with your group, so whenever updates are there, so I am also at my home studying for FRM. So just saw the message that meeting is there, a class is there. So
Okay.
accordingly, I joined today because I was on holiday today. So that is also
Yeah, 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 yeah. I
for
think
me.
third and fourth, today is
It's
third or fourth Saturday.
second and fourth is holidays for us currently.
Okay.
So today is fourth Saturday holiday is there.
So today's
So I
fourth
was
Saturday, is
fortunate.
it?
Yeah.
No,
That's why
that
I
excellent,
joined.
excellent, excellent, excellent. All right. So without much, and this session is going to be fun. Anusha, Murali, Abhishek, Utkarsh, and the rest of us as they are joining in. This session is going to be fun. So first and foremost, let me ask all of you that what exactly do you understand by derivative? And be frank, anybody can answer. What do you understand by derivative? Any idea? All right. So if I tell you that the word derivatives, when we say, this directly connotes to that something which derives from. Okay, so that's very, very important. See, because this is where the finer nuances actually comes into picture. Because most of the people, when they start, they directly will start with the chapter. Okay, this is what your syllabus is, and this is how. Okay, no. So let's first understand that why the word derivatives has been used. Okay, so it derives from something. That is why it is called derivatives. Students of calculus, students who have studied calculus in their +2, they would perhaps associate with derivatives as well. And yes, the form of derivatives that we are going to talk about, they have some similarity with those kind of derivatives that we study in mathematics as well. Now, when we say it derives from, that means it derives from something. Whatever it derives from, let's term them assets. In fact, it would actually be wrong to say that they can only be assets. Why? Because they can be also one more derivative. Now, I know at this point in time, it might sound a little Greek, Latin, a little confusing, and perhaps a little wayward as well, but stay there, stay there. So let's choose a better word. Okay. And the better word is that derivatives is something which derives from something which we are going to term as underlying. Okay. Underlying. Okay. Now, when we say underlying, then the underlying can be an asset. Underlying could be another derivative as well. Okay. That's the first thing. The second thing that we must understand, and that should be understood holistically, even before we can begin the chapter, is that you cannot, nobody can own a derivative. Okay. So neither I, nor Abhishek, nor Utkarsh, not Anusha, not Adani, not Modi, not Donald Trump, nobody can own a derivative. Okay. It is impossible. So you would say, what exactly are we talking about? We always hear that somebody takes a long position, somebody takes a short position. I'm sure that you ought to come across these terms as well. Long position, short position. They take some position. What is meant by position? Yes, they take position. That does not per se mean that they own the derivative. Why? Because the very essence of any derivative is that any derivative must have a defined timelines. That means a defined life. Okay. That means there is a start date. That means just like any living being, there is a birth date and then there is an end date to derivative. Now you would say, but is this not true for other? No, it is not true for others. Why? Because come to think of it, that when we talk about, let's say, a stock. Okay. Now one more thing I wanted to tell you, don't get me wrong. I deliberately do not put my other title because I have not taken the charter of this. The charter comes very expensive and per se it is not essential for my day-to-day work. So I don't write this. Don't get me wrong. But except for taxation, I'm into every other thing. That's the point. Okay. Now, when we talk about derivative, there is a defined start and then there is a defined end date. That means there is a lifetime. Okay. If you compare this with an asset, for let's say we are talking about a stock. Okay. Now, once the company is incorporated, the stock comes into being. We all understand that. But is there an end date of a stock? The answer is no. Unless, of course, the company is liquidated. Now, still better, if the stock is actually floated in the capital market. Okay. If it is floated in the capital market, wherein it can trade freely, in that case as well, the stock trades forever, unless, of course, the stock exchange actually goes out of business. That's all put together. Even in that case, also, people who are holding their stocks, the government or the financial system or the financial mechanism of the country would find a way to support the owner of the stocks. Now, see how smartly, how tactfully, indirectly, I use the word owner. Why? Because you can own a stock. I can own a bond, but I can never own a derivative. I can take position in a derivative, okay? But I can never own a derivative. Via this position, there is something called as fractional ownership. Why it is called fractional ownership? I'll come to it a little later on. But one connotation of this fractional ownership means also that even if you take a position in any derivative, you can own that derivative or have that position for a defined timeline. After the defined timeline, the position for you will become zero. You cannot own that. Okay. So two things that we understood. First and foremost, the word derivatives means that it actually derives from something, and what it derives from, it can derive from an underlying. An underlying could be an asset or another derivative as well. A derivative for this particular sense is also known as financial instrument. Financial instrument. Okay, or we can also say that this is a financial security, but we can never say a derivative to be an asset. Nobody can say a derivative is an asset, because an asset you can own, and an asset is supposed to depreciate. That's what accounting rule tells us. There is no such thing as asset when it comes to derivative. There is no such thing of depreciation as we know it, because it is not an asset. Okay, so two things important. One, a financial security or a financial instrument that derives its value from something else is called a derivative. First and foremost, that something from which it derives this value from could be an asset, could be another derivative also. Collectively, they are known as underlying. Second, nobody can own a derivative. Third, every derivative has a specific start and a specific end date. Precisely why every derivative is called also a derivative contract. Okay. Why we call a contract? Because always you know for a fact that every contract has an initiation date and an expiry date. So that means it has a defined timeline. So are we all on the same page as far as this basic understanding of derivative is concerned? Can somebody say yes or no about this? Or
Yeah.
any? Okay, great. So with this now, of course, these chapters are there. So we are going to delve in these chapters as well. But these are the learning outcome statement as per the 2026 curriculum which is there. You can pause the video. I will share this PDF as well, this presentation as well. This is made by me. So I'll freely share this. Don't worry about it. But let's get into the uh, nitty-gritties, the weeds of the things. Okay. So as far as our curriculum is concerned, our basics of understandings of derivatives are concerned, we are going to talk about perhaps two or three basic derivatives. Okay. Which are those? We're going to talk about something called as options. How many of you have heard of options?
Yeah, I've heard about it.
I'm sure that Anusha also would have heard about it. So is Murli as well, right? So option is option is one sort of derivative contract. Then you would have also heard about forward and futures.
Futures.
Okay, these are again derivative contracts. And the third derivative contract that you are going to talk about, or you're going to be taught about, is something called as swap. Something called as swap. These three will form the fundamental building block of derivative. Now, there are variations. There are variances and variations of these things as well. For example, swap also comes along with a different flavor of swap, something called as total return swap, equity swap, interest rate swaps, so on and so forth. Options are also, different kind of options are there. We call them call option, put option. Of course, you would have heard of, but then there are other types of classifications of options as well. European options, American options, then those exotic options called Asian options or clique options. For various things are there. Of course, we're going to learn about it. But the basic point is that when we are talking about derivatives, we are essentially talking about these three types of contracts. Are there other form of derivatives as well? Of course there are, but they are again flavor of one or the another. For example, how many of you have heard of something called an ESOP, Employee Stock Option Scheme? ESOP.
Yeah, I have it in a contract.
You okay? Somebody
Yes,
says
sir. We have
okay.
also heard.
You have it. So can you tell me what it is exactly? What is this ESOP all about?
Basically, we get some option to buy stocks at particular price, and yeah, I mean,
Yeah,
for a
tell me.
company which we are working in.
Okay.
The employees of the organization get the opportunity to buy the stocks of the organization at a lower price as compared to the market.
Anybody else wants to throw some light about it on options, ESOPs? Murli, maybe perhaps you. What
Yes,
is an
sir.
ESOP? Yeah, what is an ESOP? Any idea?
It is a actually it is a benefit to the employees of the organization that they will get their price at a discounted rate than their market rate.
Okay, so I like Murli's answer in particular. You know why? He says that it is beneficial. It is beneficial for employee, right? It is beneficial for an employee because the employee can get the shares of the company, the stocks of the company at a discounted price, at a much depressed price than what it would be in the open market. That's what Murli says, right? Am I right?
Yes, sir.
Yeah.
Correct.
So later on, you would know that I do not know how much beneficial it is for the employee, but most definitely it is beneficial for the organization, whichever way you want to look at it. Okay, because first and foremost thing that all of you should bear in mind, because all of you are actually professionals, right, working. Please understand that your ESOP is part of your compensation. Am I right? It is part of your salary. It is part of your compensation. But what is important is that this compensation is a non-cash compensation, right? It is non-cash compensation. And what it tells you, tells you that, boss, the day you joined today, you have been given a right. You have been given a right. To do what? A right to purchase the shares of your company, that is the company that you are working in, at a particular rate in future, not today. Not today. So, for example, if I'm being given, let's say, 500 ESOPs, it is not like that I can cash on these ESOPs immediately. Okay. It is always going to be a function of various things. First and foremost, it is going to be a function that you will have to work for some number of years. You'll have to work for maybe 1 year or 2 year or 3 year, even before you can think of actually exercising this ESOP. Am I right?
Yeah.
Right. So this ESOP is definitely tied to a vintage. Like how many years you work or how many days you work, it is going to be one of the major determinants of whether you're going to exercise this ESOP or not. In other words, it also becomes a retention tool. Am I right? Because if you are being given the ESOP, you cannot sell this. These are also known as RSU, restricted stock units. You cannot sell this ESOP in the market. You cannot trade this to anybody. You cannot pass on this ESOP to your wife, to your husband, or to any of your colleagues. No, it is not possible. It is only meant for you. Second important thing is, we talked about vintage. Second important thing is performance. What is meant by this? So it tells you that if, what I'm saying is that if you perform well, you as an individual, you perform well, then definitely this ESOP could be beneficial for you. Right? That's what you will be, you will perhaps take home as far as the meaning of ESOPs is concerned. But not only this, it is also contingent. The true word out here is contingent. It is also contingent on how the company performs. More precisely, if the company is already traded in the open market, in the capital market, then how the company performs, the ESOP is also going to be dependent on the same. Why? Because, for example, when the ESOP was granted to you, let's say the company was trading at 100, okay, INR 100 per share. It was trading at INR 100 per share. Now you are being told that you can only exercise this 500 ESOPs that have been given after you have spent maybe 18 months in the organization. So after once 18 months is over, then you can exercise this ESOP. You can encash this ESOP. Okay. And that too, you cannot encash the whole 500. You were only allowed to encash the first 100 only. Plus there is one more catch. And the catch is that by that time, the share price must be 120 or 140 plus. This is just a number that I'm making. If that happens, then you can purchase this share at 100. Clearly, if you purchase something at 100 legally, which is the market price of which is 40, 140, you make a clean sweep of 40 bucks here per share, isn't it? That's how ESOP works. Now, can you tell me, is this ESOP a derivative or not? Follow back the principle and let me understand that whether it satisfies the three principles we talked about and whether this is a derivative or not. Please answer me.
Yeah, I mean, it does follow the basic company stock, so and it looks like, yeah, it's a derivative.
It's a derivative. Others? Murali, Anusha?
Yeah, actually, we can exercise that option after a particular number of years or months. That definitely one of the condition for, because it has a fixed start and end date. So that falls into that. And it depends upon the value of the share in the traded in the market. So it is deriving its value from the value of the stock in the market. So both it satisfies the condition.
Absolutely, absolutely correct. Okay. Plus, it has a certain vintage. ESOPs cannot, it's not like that you can carry on the ESOPs forever.
Yeah.
Okay. So, at one point in time, A, your start date is going to be defined that you can only exercise after a certain date. And B, you will also have to exercise this within a certain date also. It's not like, you'll be allowed to carry on these ESOPs forever. So, period. It is already now been established. ESOP, yes, Abhishek, you're absolutely right. ESOP has ownership. ESOP has ownership. When it has ownership? When it is exercised. And when you are exercising it for a share, then you have an ownership. If you leave the company, then your ESOP is also gone. For example, if I leave the company before the vesting itself, my vesting starts at 2 years down the line. So before 2 years, if I leave the company, it is gone. It is gone forever. Okay. Second is, if you carry along the ESOP for, let's say you have joined the company at a let's say 2015, you've joined the company. Your vesting starts from, let's say, 2017. Okay. Your ESOP contract, as it is, I'm considering that the earliest ESOP that you have got, because ESOPs are also they do get accumulated. Like, for example, if I work for 2015, I joined the company. 2016, again, I will be entitled to certain ESOP. 2017 is also, I will be entitled to certain ESOP, so on and so forth. So I'm considering the earliest ESOP that has been given. So the earliest ESOP's vesting will start 2 years down the line as per the contract. And then I can only exercise 100. If I exercise, I have a choice that whether I want the underlying asset or not. If I'm asking for the underlying asset, in the parlance of finance, it is called delivery. That means you have taken the delivery of the underlying. But more often than not, mostly people, what they do is that they encash the ESOP. Yes, you can also take delivery. Okay. Once you take the delivery, then definitely it becomes your ownership, but only proportion to the ESOPs that you have exercised. Second thing is that the earliest ESOPs that you had of 2015, which you can start exercising from 2017, can you carry this forever? I doubt. There is going to be certain termination date of this particular ESOPs as well. The ESOPs which you will be entitled in 2016, 2017, 2018 onwards, they will also have certain predefined dates. Within those dates, you will have to exercise. If you don't exercise, then they will expire. Okay. So ESOP is a derivative contract. And more precisely, if you look at it, this is actually very similar to something called as call option. Call option. Okay. Now let's go back to some of the history of derivatives itself. So is derivative something new? No, the answer is no. Derivatives is not something new. For example, you would have heard of this famous Greek philosopher Aristotle. What he used to do is, because he was very well adept in those times in understanding the planetary movements and how the weather patterns are going to actually change in the next following year. So he would predict that the next year there is going to be good rains or bad rains. So accordingly, what he would do is that he would buy the olive firms from the nearby, from the farmers in and around the city of Athens in ancient Greece. Okay. Now, when he used to buy those, obviously he was taking the bet that the rains happen as per his expectation. Should that happen, then obviously he's going to get a good yield. Okay. Now, you would say that if this is an outright purchase, then how this is a derivative? Well, what he used to do is Aristotle used to not exactly buy those farmlands, but he used to enter into a contract to buy. A contract to buy. Buy from whom? From the farmers. Which date? Maybe 6 months or 1 year down the line. And at what price? That price is going to be decided today itself, the day the contract is drafted. The day the contract is drafted. Now, which kind of derivative contract is this? This is something very similar to something what we called is the forward contract. Forward, sometimes we also call them the futures contract, but that's one of the story. And Abhishek, of course, actually raked a very important point that we initially discussed, that in case of derivative, there is no ownership. Then how this is happening? Well, of course, in case of derivatives, ownership per se does not exist. What happens is the contract, when you exercise, the legacy of that contract changes into something called as ownership. For example, a forward contract is what we called is a deliverable contract. What is meant by deliverable contract? So the deliverable contract would mean that against the contracted price, the seller is going to give the buyer the underlying and then accept the cash. Which cash? The cash which was pre-decided at the time of drafting of the contract. So these kind of contracts are called as forward contracts. But forward contracts are mostly OTC product. What is meant by OTC product? They are over-the-counter product. These products are not freely traded in the open market. In the open market, the contracts that are being traded, they are 100% non-deliverables. That means they are cash settled. That means they are cash settled. Now, let's get into that. What are the use of actually derivatives? So far, we have understood that, so there's something called as derivatives. There is something called as contract. We understood the basic 3 tenets of derivatives and how they differ from assets. They derive the value from the underlying, etc., etc. Now, what derivatives are actually used for? So if my understanding is correct, there are 3 possible uses of derivatives. The first of which is basically called as something called as risk management. Okay. Now, anybody would want to put in or throw in some light that what exactly are we talking about when it comes to risk management? Anybody?
So like the basic idea which comes to me is when we own a portfolio, there is a possible loss that we know the value might go down. So to hedge that, we purchase some options so that whenever the opposite happens, we can exercise those options and then our portfolio is hedged.
Okay. So we say that risk mitigation is one of the key objective. The whiteboards do not work properly in Zoom. I do not know why. Risk mitigation is one of the key objectives of derivatives. Okay. When we say risk mitigation, we are essentially talking about something called as hedging. Okay. Let's take an example. Let's say I am talking about the today's forex rate of INR versus US dollar. Let's say the rate that is prevailing is rupees 92 per dollar. Rupees 92 per $1. Okay. Now let's say that I am an importer. I'm an importer. An importer is obviously going to import. Okay. Now, I have certain contracts. Those contracts are long-standing contracts with my vendors. And via that contract, I say, I would import, let's say, XYZ, whatever trade that I am in. But let's say I'm going to import 1 million worth of goods from abroad. 1 million worth of goods from abroad to be paid in US dollar. Okay. But this will happen, the settlement of which is going to happen, let's say, January 26th, or let's say January 25th, 2027. January 25th, 2027. Okay. Now, so I have certain long-standing contract. The contract is going to be settled. The delivery is going to happen and the contract is going to be settled next year, exactly 365 days from date today. Now, can you tell me what is the risk that I'm facing out here? What risk am I facing as an importer?
Dollar appreciation.
Dollar appreciation is a very big risk that I'm facing. Okay. Why? Because if by January 25th, $1 becomes 100 rupees, okay, or let's say 105 rupees, then of course I will have to pay much more in Indian rupees to purchase $1 million. Am I right? I think I'm right. Right?
Correct.
So is there a way that I cannot change the past, right? Because in past, I cannot go back in time and then recall those merry days when, $1, $1, $1 used to be 45 rupees. I cannot revisit those days. Definitely not. Okay. But what I can do is try and ensure that I get a price that is immune to the fluctuations of the Indian rupee versus US dollar, and seeing the global turmoil that we are all in because of the various things that are happening across the world. Uh, you all are aware. I don't think I need to actually stress upon that. There is a telltale possibility that rupee may actually further plunge and can't actually touch the figure of 105. Now imagine from 92 to 105, there is almost 13 rupees depreciation of dollar. So 13 rupees depreciation, I think it is around close to, around close to 16%, isn't it? Yes, it is going to be around 16%. So that means if in the spot market, on the day that I have to make the payment, if I actually purchase the dollar, I will definitely be purchasing the dollar 16% pricier, 16% more expensive. Now, is there a way to actually get around this problem? The answer to that is yes. How? So what I should be doing is, as an importer, I should be trying to get hold of a dealer, right? I should go to this dealer and ask. More often than not, these are basically banks. This can be commercial banks. This can be, of course, as a retail importer, or at our end, a retail importer, I'm talking about retail importers. So commercial banks are absolutely fine. If you're an institutional player, then it becomes something different, of course. So let's just stick to this example. Excuse me, commercial bank. So a dealer or commercial bank, I go, and not all commercial banks are actually allowed to carry forward this transaction. Also, you must bear this thing in mind, because most of you who are working here are bankers, the ones who are attending the classes. So if the commercial banks are authorized to actually carry forward or enter into a transaction, then what you could do is that you could book a forward contract. Okay. You could book a forward contract and say that I am going to purchase dollar from you worth 1 million. I'm not going to purchase it today. I have just entering a contract with you to purchase it on January 25th, 2027. This is the day that I'm going to purchase. Or let's say January 24th, because I have to make the onward settlement to my importer. So I'm taking just one day prior. So let's say January 24, 2027, I'm going to purchase this. And today we agree upon that price. And suppose that price that we agree is, I'm just giving an example, making certain number, is 98 rupees per dollar. Okay. Once we enter in this contract is locked. What is meant by locked? That means that this contract is legally enforceable. It has to be honored across anywhere. Nobody can actually violate this contract, neither the bank nor you. Okay. Nobody can rescind this contract. You will have to purchase the dollar come hell or high water on January 24th. And the bank will also have to make available dollar to you on January 24th. It is an inescapable locked in contract between the both of you. And also at the locked in price. So in this process, what we have done is we have hedged against the possible volatility or the possible price appreciation of the dollar itself. Right? So this is one example of risk mitigation. Mind you, this contract is being drafted and is being executed today. That is, I'm talking about January 24th, 2026. Today, the contract is being actually drafted and is being executed. Okay, to be settled in January 24, 2027, 1 year down the line. Okay, so if you do this, so obviously what the importer has done is that he has hedged against the possible currency risk. Let's turn the table and say that we are an exporter. And in exporter, what is going to happen is that obviously we are going to receive money. Am I right?
Correct.
We're going to receive money. So in this case, iPhone guest, can you please either mute your mic because it's yeah. Can you identify yourself who has joined in just? Somebody has joined in, but his or her name is not visible. Can you please identify? Oh. Welcome, Rajesh. Please keep your mic in mute mode unless you have to raise a question. Okay. Now let's take the example of an exporter. So an exporter, what does he do? Of course, he would obviously be exporting something against which he is going to receive his payments. Let's say his payment is also being received into US dollar, right? So in case of the US dollar, if he's receiving, let's again draft the same exercise wherein 1 US dollar is equal to 92 Indian rupees. Okay. And this exporter is going to receive his payment January 25, 2027. He's going to receive the payment. Right? Today's price, we have already discussed, it is rupees 92. January 25, 2027, he's going to receive the payment. How much payment he's going to receive? Let's say he's going to receive a payment of $1 million from his customer. Okay. Now, there is one thing that we need to understand. As an exporter, okay, barring certain percentage, which per se is not important, barring certain percentage, the government of India will not allow you to keep the money in dollar form. I hope you are aware of this, because this directly affects our treasury. So that in that case, what the government of India will do is that the government of India will definitely ask you to convert this dollar into Indian rupee, right? That's what's going to happen. Now, regardless of the fact, let me understand what is the risk that you perceive out here as an exporter. Can somebody tell me what is the risk that you perceive?
The value goes down.
Which value?
I mean the dollar to rupee. So like it becomes 90, let's say.
Yeah. So what would happen is that in this case, we were concerned with dollar appreciation, because dollar appreciation in a relative term definitely means rupee depreciation. Am I right? As
Correct.
an importer, that was the problem. But as an exporter, what is the problem now? Rupee appreciation. As an exporter, if rupee, that is my domestic currency, if that appreciates, then it is bad for me, because rupee appreciation will definitely tell us that on a relative scale, dollar has depreciated, right? So what will happen? So you can understand that if 1 million, you will still go, the exporter is still going to receive 1 million, but against 1 million, his Indian yield would have been 92 into 1 million. That means he would have gotten 9.2 crore. He would have gotten 9.2 crore. That is the spot price. But 1 year down the line, if dollar depreciates and rupee appreciates, it's possible that at that point in time, if dollar becomes 88, then of course he will be getting only 8.8 crore. Am I right? So you can imagine that there
Yes.
is already a 40 lakhs loss as far as the exporter's yield is concerned. Maybe this 40 lakhs was his profit, part of his profit, which he is losing. He would be very happy if dollar appreciate. He would be very happy if dollar appreciates, because dollar appreciation would mean his rupee yield will go up. So you can imagine in this case, if this is the case with the exporter is very happy. And if this is the case with the importer, then the importer is very happy. But when we turn the table, this becomes the risk for the respective parties. So again, in this case, is there a way to actually mitigate this risk? The answer to that is again, yes. What will you do? Well, it's simple. Again, the exporter is going to enter into something called as a 1 year forward contract, wherein it will contract to sell US dollar. In the earlier case, as an importer, he was to buy US dollar. And in this case, as an exporter, he would enter to sell US dollar. Okay. And then carry rupee with him. And in that case, what will happen is that they obviously are going to settle their terms, and maybe that would be around 95 rupees a dollar. Okay. 95 rupees, $1. Now, as before, this contract is locked, legally enforceable. Nobody can rescind this contract. Everybody, whether the bank or the dealer out here, the exporter out here, the importer out here, they are to honor this contract as it should be. Okay. But in either of these cases, rather in both of these cases, you would see that they have actually attempted to mitigate their risk. That means they have hedged their risk. So from the point of view of hedging that we were talking about, obviously you can understand that this derivative contract called forward contract, in this case, which is also deliverable contract, because what is happening? Dollar and INR, they're exchanging hands. So to answer Abhishek's question again, that this a deliverable derivative obviously will give you ownership, just like a forward contract. So in this case, what is happening? Dollar and Indian rupiah, they're exchanging hands. So one asset is being traded for another. Okay. But in both these cases, the counterparties are attempting to mitigate their risk. Let's take one more example. And this example, let's say, suppose I'm talking about a portfolio manager. A portfolio manager. The portfolio manager has a portfolio of, let's say, 100 CR. This 100 CR, of course, consists of your stocks, your bonds, maybe some cash instruments. Cash instruments are again bonds only, fixed instruments, fixed instruments. Okay, maybe some hybrid securities, etc., etc. Now, what do you think? So typically, when a portfolio manager is holding these assets, the portfolio manager is said to have a long position to this portfolio. Okay. Now, let's first understand that what is the risk that the portfolio manager is seeing here. Can you tell me what are the risks the portfolio manager is facing here? Anybody? Anusha, Murli, Utkarsh.
I could not get the question. Can you repeat it once more?
Yeah, so I'm talking about a portfolio manager. A portfolio manager is somebody you would have heard of, like mutual fund portfolio manager, etc. Okay, so
Correct.
he's holding some assets. So the portfolio is valued currently at 100 crore. Market value of that portfolio is around 100 crore. That consists of several assets like stocks, bonds, etc., etc. Okay, now whenever a portfolio manager is having any asset under his custody, what is the risk? What is the primary risk the portfolio manager faces?
I mean, the value will go down.
Value will go down. Absolutely correct. The value will go down. Right? Now, let's say a smart portfolio manager understands that given the current scenario of the Indian market, the Nifty is not giving us any return. I'm sure for the last 1.5 years, all of you have seen that the Nifty is barely giving us any return. In fact, it has given negative return, if anything. This year itself, because of the lot of things that are happening across the world, Indian market is not performing well. So is the world market also. They're not performing well. There are too many risks which are there. Now, let's say the portfolio manager sees, after the due analysis, the due diligence that he conducts, he sees that the next 6 months are really going to be a tumultuous month. But after maybe July of 2026, things will start looking up. Things will start looking up. Okay. Now, as Utkarsh rightly said, that this 6 months, he's expecting that because of the turbulence that's there in the market, it's quite likely that the kind of assets that he's holding, he might actually incur 15 to 20% of depreciation in his portfolio. In other words, 15 to 20% of losses. And he wants to arrest these losses. Okay. Now, when he wants to arrest these losses, he goes to his boss. His boss says, well, try and see how you can actually arrest these losses. So the portfolio manager says, well, you know what? I can purchase some put options. I can purchase some put options. Why? Because the put options gives you the right to exercise the option without having any obligation. What do we mean by that? I'll come to it a little later on. In details, we're going to talk about it. But just know this, that the fundamental difference between a forward contract, future contract, and that of an option contract is that a forward contract or a future contract, they are obligatory on both the long to the contract and the short to the contract equally. So when we say that, as we discussed about the Forex wala thing, when we said that, somebody is buying dollar or somebody is actually selling rupiah, so it is the onus is equally binding on both of them. And both of them will have to execute discharge their responsibility. But in case of an option contract, what happens, even though there is a buyer and a seller of option, the buyer has rights in an option contract, but no obligation. And the seller has all the obligation in the contract, but no right in the contract at all. What that means, we will discuss it later on. But just know this for a fact right now, that one of the ways that portfolio managers can actually hedge this risk is he or she can purchase some put options. Why put options? Because put option gives him the right to exercise the put option if certain asset price goes down. I'm sure you would know that how the put option pays. Put option pays when the market goes down. If you're anticipating something will go down, you've purchased a stock for, let's say, 100, and if the stock actually is likely to go to 80, that means you're going to incur a loss of 20. So immediately what you could do is that you can purchase a put option if that is available in the market, and then you can arrest this loss. Okay. So similar objective the portfolio manager has out here, only the scale differs. The scale is of 100 CR, and then he goes to his boss. His boss says, well, one of the ways of actually doing this is that you can purchase some put options, right? Because if you purchase put option for the next 6 months, then what will happen is that whatever loss that you will incur here. Let's say you incur 15% loss here. 15% loss is 15 crore. But the same 15 crore loss is going to be compensated by the put option dealer or put option writer or put option seller. Okay. So 15 crore will be gained from the short position. We call this short position. 15 crore loss will be from your asset portfolio. They will cancel each other, and hence then your portfolio will remain hedged. No profit, no loss. It sounds fine. Is this one of the way to mitigate the risk? Yes, there is. But there is a small problem. The small problem is that when we talk about this put options, as we said, that the buyer has the right but no obligation. Where does this right and obligation thing comes from? Let's also understand this thing. In any option contract, whether it is a put contract or a call option contract, the buyer has the right but no obligation. The seller has no right but full obligation. How does this happen? Because in case of a forward contract or a futures contract, the rights and obligations are equally decided, whether it is a buyer or it is a seller. Okay? So right and obligation, if we segregate, so buyer also has 50% right, 50% obligation. Seller also has 50% right, 50% obligation. But not so when it comes to put option or call option, any option for that. Why and how? Because in this particular case, in case of a option contract, the buyer purchases all the rights of the seller against something called as option premium. Option premium. That means at the initiation of the contract itself, the buyer must pay the seller the value of the option contract as has been decided. What is that value? I'm not getting into that right now. It's not important as of now. But just know this, that at the initiation of the contract itself, any option contract cannot initiate unless the buyer has paid the premium to the seller. And when the seller gets the premium, the seller loses all its right and buys in all the obligation. And on the other hand, the buyer, since he has already paid the premium, does away with all the obligation and only retains the right. So in this case, coming back to our portfolio manager's example, the portfolio manager indeed can hedge the risk by purchasing certain put options. But for purchasing these put options, the portfolio manager will have to pay something called as premium. So his boss says, well, that's one of the ways. But then in case of premium, you can understand for 100 crore portfolio, we might have to pay a premium of 3 crore. So net, yes, you are going to save 15 crore, but 3 crore premium you'll have to pay. That's a big thing, yeah. Why should I give you 3 crore? Why should I allow you to spend 3 crores? Because if the market does not go down as has been anticipated, in that case, this 3 crore is gone forever. The seller is not going to return you. The seller of the option contract will not return this 3 crore rupees to you. It is gone. So the portfolio manager thinks. And he says, well, you know what? In India, the retailers are now participating big time in the options market. Okay, you have already know that SEBI has come out with so many warnings that how retailers lose money by getting into options contract, trading into options contract, and so. But for a portfolio manager, how does it matter? He is emotionless. He has to be emotionless, right? Cold hard money is what is driving him. So he says, and he goes to his boss and says that, boss, I have found a way. So his boss says, wow, how come you found a way? So portfolio manager says that, you know what? I am definitely going to buy these put options. I am going to buy these put options. Okay. But I am going to not fund these put options. What does it mean? So it means that I will not pay this premium and yet I will buy these put options. Interesting, isn't it? It is interesting, right? How does it happen? So he says that, boss, what we should do is that on this 100 crore of portfolio that we have, and since we already know that for the next 6 months, the market is very, very unlikely to go up. In fact, it is very likely that it is going to give us negative return. So let's do something. Let's start selling in the market some call options. See how tricky this thing is becoming now. The portfolio manager says that on my portfolio of stocks and bonds, I can sell some call options in the market. There are YouTubers, there are influencers in the market, there are mutual funds experts, then there are market makers who will advertise for my call options. They will say all the good things. No, 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 no. Trump is not going to get Greenland. Don't worry about it. Everything is good and good. Nothing is going to happen. Market is only going to go up. Don't worry about it. Please buy call options, because if you buy call options, market will go up and you will benefit. At least I'm sure that you know this. Even as novice traders also, we know this. Okay. So if he starts selling these call options, what will happen? Now he becomes the seller of this call options. See how the tables are changing. On one hand, he's buyer of the put options, and on the other hand, he's the seller of the call options. On one hand, because he's a buyer of the put options, he will have to pay the premium, right? He will have to pay the premium for put. He will have to pay. But when he's the seller of the call options, he will get the premium. Okay. And if he fixes the proportion correctly, if he does the math correctly, the premium that he should be paying for the put option, the premium he should be paying for the put option, and the premium that he's going to get out of by selling this call option may just cancel each other. I'm taking a very hypothetical example just to drive home the point. Don't go by the literal figures out of this. Okay. Net, his premium payment is becoming zero. And if his anticipation is correct, then what would happen? If the market remains as it were, as it is neither loss nor profit for him. If the market goes down, then of course, he will have to pay nothing as part of the call option writer, because as a call option writer, he has all the obligation. If the market goes up, then the call option writer will have to pay. But if the market does not go up, in that case, he will get to keep the premium. And if the market goes down, then obviously whatever loss that he is going to incur, the put option, whoever has sold him the put option writer will pay him and compensate for him. Now, one question I'm sure that you would be asking, what if both of the anticipations are wrong? That means market does not stay at the place, market does not go up, market does not go down as was anticipated. In fact, the reverse happens. Okay, because it is stock market, anything can happen. All that we do is some silly analysis, and those analysis can always go wrong. And if the market does go up, then what happens? Because we have just said that in case of call options, he's a call option writer. So as a writer, he will have to shell out from his pocket. Then in that case, is he not actually incurring loss? The answer to that is no. He will not incur loss in that position also. Why? Because please understand, he has written this call option on the 100 crore of portfolio. He has written some call option. Let's denote them as C minus. Okay. He has received certain premium. Let's say the premium does not matter because he received 3 crores of premium. He paid 3 crore of premium. So net premium is zero anyway. So let's just not get bothered about the premium. Let's just take the three hypothetical situations. Stays along, we have already discussed. Goes down, we have already discussed. Now we are discussing what if both anticipations are wrong and the market in fact goes up. In that case, what happens? So if the market goes up, in that case, what will happen is definitely from the short call, it is called a short call because he is the writer. He has sold the call option, so he will be called as a short call option writer. So the short call option writer, which in this case is our portfolio manager, he will definitely incur now loss because he will have to make some payoff. That is called payoff. He will have to make some payoff. Payoff to whom? The ones who has bought his option contract. He'll have to definitely make those payoff. No doubt about that. But this call option was written on this portfolio, right? If the market is going up and because of which he has to make the payoff, then his assets value is also going up, isn't it? His asset value is also going up. So net, what is happening? His 100 crore would become 110 crore. And here he will have to make a payoff of 10 crore. Again, this 10 crore will cancel out. His position still remains at 100. Okay. Now this arrangement is only for 6 months. Only for 6 months that he's making. Now I know this may sound a little esoteric. This may sound a little, I would say complicated to begin with, but I'm sure that this was an interesting example. How many of you found this as an interesting example? Please tell me. Did you find this an interesting example?
Yeah.
So you have any questions on this? Okay.
C minus that we are the writer of the call option. Now that part you have to just explain little bit.
Okay. So don't see what happens is normally what happens is
Sure.
it is just a convention that when we sell call option, so we denote this as C minus. When we buy some call options, we denote this as C plus. Now in my work, I exactly use the opposite terminology. I will explain later when we cover the option chapter that why I use the opposite terminology. That I will explain later. So what is happening? Let's understand. Similarly, if you're selling the put option, it is denoted as P minus. If you're purchasing put option, it is denoted as P plus. Okay. Now, let's understand what's happening. When the issue came up, at that point in time, the portfolio manager's total value of the portfolio was 100 CR. His problem was what? His risk anticipation was that the market is going to tank. And if the market indeed tanked, then obviously he's going to incur a loss. Okay. He might incur a loss in the vicinity of, let's say, 15 CR. Okay. Now, this, of course, is definitely a great thing to have happened. So he wanted to hedge this risk. Now, there are various ways of hedging the risk. So first we discussed that, okay, let him buy some put option, because if we buy some put option at 100 CR, and we are going to denote this 100 CR as strike price. Don't worry about these terminologies, okay? Don't just worry about these terminologies. All that it says is that your counting of payoff or pay-in is going to be decided from this reference point of 100 CR. That's all the strike price means. Okay, just understand this. So at 100 CR, when the value of the portfolio was 100 CR, he purchased those put options. Now, if his anticipations were right, it would have gone down. So what would happen? His portfolio would have become 85 crore because 15 crore loss would have been here. No? So he's going to suffer 15 crore loss in his portfolio. Asset portfolio is going to suffer the loss. No doubt about it. But because he has simultaneously entered into a derivative contract by purchasing those put options, the put option writer will also have to make the payoff. No? So what will happen? 15 crore loss from the asset portfolio, but 15 crore payoff or profit from the options contract. They're going to cancel, and obviously your portfolio is now going to be hedged. Zero. No profit, no loss. That's what the meaning of hedging is all about. Okay. This is the most basic thing that any portfolio manager can do. But what did I say in addition to that? That boss, the small problem is that whenever you'll have to purchase this put options, you'll have to pay the premium. And premium is hefty. Premiums don't come cheap. So let's say this premium, somebody who is selling this, he's selling it at, let's say, 2 CR premium or 3 CR. So in that case, what would have happened? His asset portfolio may still be completely hedged, but he had to pay the premium, na? So 2 or 3 crores of cash outflow would have happened anyway. So the next level of thinking was that how to make it a zero cost risk hedged portfolio. So we were talking about second level of optimization, second level of risk management, second level of hedging, exactly what a risk manager actually works in his day-to-day work. Okay. So in that case, what happens was that he entered into 2 contracts. In one contract, he came in as a put option buyer, that if the market goes down, the put option writer is going to pay me. That is fine. Portfolio has hedged, but this comes with a premium. So he entered to mitigate this extra premium that he had to pay. What he did is that he entered into one more contract wherein now he is no longer a buyer but a seller of call option. Now you would say, why he wanted to sell the call option? Because his anticipation was market is going to go down. When market is going to go down, most of the asset managers would want to sell the opposite. They will take the counterproductive views. Precisely why you should not trust blindly those CNBC pundits, Aaj Tak pundits, ET pundits. Okay, they are all paid puppets. 99% of them are paid puppets. They are paid to say things which will benefit the institutional investors. I say this boldly. You can quote me anywhere. Okay, this is no longer a rocket science. Everybody knows this. So what happens is that if he starts selling the call option, he's going to get premium. So in one hand, premium was going out. On the other hand, premium was coming in. If the proportion is correctly calculated, then both the premiums can cancel each other. If they cancel each other, what will happen? It will become a zero cost portfolio. It will become a zero cost portfolio. So now let us again revisit the whole thing. If the market goes down, in this case, his objective is fulfilled. If the market remains at his place, that means his objective is anyway fulfilled. And now we take the extreme scenario wherein the portfolio manager's entire anticipation went wrong. If the anticipation went wrong, in that case, what will happen? Markets, which is right now, let's say trading at, let's say 25,500, in the next 6 months becomes 27,000. I'm talking about Nifty. So if the next 6 months, if the market indeed defies all projections, all anticipation, because it is market, it can behave erratically. It is not actually it is not under any sort of obligation to us. Now, in this case, what will happen is if the market indeed goes up, then what happens? The portfolio manager's anticipation would have gone wrong. But in that case, is the portfolio manager losing? The answer to that is no. In that case, also his portfolio is hedged. That's what we are discussing. How? Let's imagine. So imagine that the market goes up. If the market goes up, what will happen? This 100 crore will become, let's say, 115 crore because the market has gone up. So his asset portfolio is in profit, right? But since he has entered into the second derivative contract, wherein he has sold call option, instead of buying put option in the first contract, he has sold call option. So now the call options buyer are going to come back to him and say that, boss, I have purchased call option from you with the anticipation the market is going to go up. So now the market has gone up. Now you give me my money. So you will have to honor that contract. Because what did I say? That an option writer does not have right. It only has obligation, because the option writer accepts premium in the beginning of the contract itself. Hence, it loses any sort of right. It only has obligation. On the option buyer has all the rights and no obligation. Why? Because the option buyer pays the premium. When he pays the premium, he has no obligation. If the market goes up, he will come back and ask for money. If the market remains as it is, where he will forget about his premium. He will lose that premium. As simple as that. Now, in this case, if the market indeed goes from 25,500 to 27,000, then definitely his asset portfolio will go up, which is a good thing. But the bad thing is that because of the second derivative contract which he had entered into, there the option buyers are going to come and ask for him that, boss, pay me my 15 crore because the market has gone up. Market has gone up, so pay me my 15 crore. So in that case also, what will happen? He will have to pay this 15 crore. Definitely that cash outflow will happen. But his overall portfolio out here, that has also appreciated by 15 crore, right? So again, 15 crore will go out, 15 crore will come in. Okay, net position is again zero. So in all of these three circumstances, his position is still hedged. That's what I actually wanted to tell. Is it clear to all of you?
Yes.
Yeah.
Great. So this was definitely an advanced example that I gave. But if you have understood this, I can tell you that you've understood a great deal about risk mitigation. At least the basics of risk mitigation you have actually understood. Now from this risk mitigation, talked about forex, we talked about portfolio. Other risk mitigations are also along the same line. There are contracts like swap. Okay. For example, let's take this example of this portfolio manager once again. Who is having a portfolio of 100 CR. So the portfolio manager, instead of actually buying into this call option, put option wala thing, hedging, which he did, he can also enter into some sort of swap with a swap dealer as well. Okay. That would have also been the case. And in that case, what would have happened is he would have entered the saying, again, I'm jumping a little, one or two steps, but and when we cover swaps, etc., those intricate derivatives, so-called intricate derivatives, let me tell you, derivatives is very easy, very easy. People actually make it intricate and make it sound intricate as if something it is rocket science. It is not. It is pure common sense and very interesting at the same time. Yes, there are certain quant-based derivatives which will require some profound knowledge of mathematics, I would say. Not very much, but good amount of mathematics would be required to know. But other than that, the basic mechanics, the basic idea of derivatives is very easy. You just have to apply your common sense. In case of swap, what happens? There is something called as, let me just okay. So in case of a swap, there is something called as swap dealer. Okay. And here is our portfolio manager. Okay. And what happens in case of swap contract is that they enter into something called as something called as notional value. Okay. So in this notional value, what happens? They place the principal at 100 crore, which is the value of our portfolio. Okay. They place the principal at 100 crore. And what they do is they say that we are going to exchange the returns. Okay. What does that mean? So in this case, what will happen? Notionally, not physically. Okay. Please understand this. Notionally, not physically, it would be like the portfolio manager has lent out the swap dealer 100 crore and the swap dealer has also notionally, not physically, lent out the portfolio manager 100 crore. So when you lend somebody, what does that happen? Or when you borrow from somebody, what happens? You've guessed it right. You have to pay something called as interest. Now, in this case, what they will do, they will enter into this contract by saying that, boss, there is no need for paying any defined interest. We are not going to get into paying some defined interest. What in fact we will do is we will exchange the returns. And what kind of returns? The portfolio manager will say that, boss, if the portfolio value, there is a positive return, those positive returns I'm going to return to you. So tomorrow, if this 100 crore becomes 110 crore, so this 10 crore I will pass on to you. But if my portfolio suffers a loss and from 100 crore it comes down to 90 crore, then the loss you will compensate me. Okay, this is how swap actually works. So this is again a very basic example of swap that I actually displayed in front of all of you. the way it happens, obviously, there are a lot of legalities that are involved here. Then the swap dealers counterpart, there is swap intermediary, then there is centralized counterparty, then there is margin, then there are collateral. Let's not get into that right now, but just understand this, that in principle, it is possible to actually pass on the risk to a counterparty through this derivative contracts as well. So this is third kind of contract by which the same portfolio manager can actually mitigate the risk, hedge the risk that we were discussing about. Okay. Now, since we talked about hedging is one of the aspects, let's also understand that hedging is just not the only perspective of any derivative contract. Hedging is definitely one of the major aspect of risk mitigation, because, for example, you can think of a farmer as well. So what a farmer does, farmer grows crops. Obviously, farmer going crop, you can understand that there are a lot many variables that are at play. You can have a bad rain, you can have bad yield, you can have 10 different variables going against the farmer. A lot of things can happen, right? Maybe at that particular year, if there is too good a rain, then there will be bumper production and all other farmers will be going in the market, and then the middleman will definitely have a better bargaining power, because there are too many farmers with too many produce, too much produce. So the price that they were expecting, they might not get, because the market will enter into a deep throat competition, cutthroat competition. On the other hand, if there is scanty rainfall, so you can understand the farmer is anyway going to suffer loss. Okay. Plus, there could be transportation issues. There could be political issues as well. The mandi where the farmer actually sells the produce, that mandi, it has come under some sort of political ramification. Anything. I mean, the reason I'm saying is that there could be n number of things that can actually go on between the sowing and the harvesting season. Okay. So, can a farmer hedge this risk because he has sown the seeds today, which he is going to harvest maybe 9 months, maybe a year down the line, right? So can he insure against himself against all of these risks? The answer to that is yes. How it happens? Obviously, he enters into something called as forward contract, wherein the farmer actually promises to deliver to the middleman his produce at a certain price. And the middleman out here, he will also have to honor the part of his commitment. Even if the market price is 90 rupees, that is the spot price is 90 rupees or 80 rupees, okay, he will still have to buy from the farmer at 100 only. And suppose the market is very good, the spot price instead of 90 or 80 becomes 120, the farmer will also have to sell it at 100 only. Nobody can run away from this contract. Okay, so this is how a forward contract is drafted between a commodity producer and a commodity buyer, by means of which they lock in future price, so that the impact of adverse conditions have zero to minimal impact. This is what hedging is all about. Now, there are two more elements in market as far as capital markets are concerned. One is called the speculator, and another is called the arbitrator. Can anybody tell me what is the difference between the two and what exactly do they mean, speculator and arbitrator? Utkarsh, Murli, Anusha?
I'm
Arbitrator
not
right to
really
take
sure.
the difference in the between the market prices in two different markets. He will try to take the advantages of the price variation in the two different markets. Speculator try to uh, gain through speculations, means speculation.
Okay. So let's get one thing clear. As far as hedging is concerned, we understood. You enter into a derivative contract because there is a risk, right? There is a perceived risk because of which you enter into a derivative contract. whatever that risk. You are an importer. I give the example of importer, exporter, the portfolio manager, asset manager. We give the example of the farmer as well. 4 examples we gave, and in each of this scenario, we said that there is a physical risk that is existing, because of which some sort of hedging mechanism will have to be implemented, and of course, because derivative contracts comes to the rescue. Okay. Now, also understand same one thing. In each of these examples, we assumed that for every party, there is a suitable counterparty existing in the market, right? We just readily assumed that. We said that there is a farmer, he wants to enter into a forward contract, and he can enter into a forward contract. How did we say that? Because please understand, a hedger's counterparty, as we understand, can be a hedger with an opposite view, right? So, for example, when we talked about, let's say, this portfolio manager having 100 crore of portfolio, and he entered into put options, etc. So please understand, the one who is selling him the put option, he must have a different view than the portfolio manager. That is why the put options are there, right? Because who would otherwise want to enter into a contract knowingly that he is going to incur a loss? Nobody would do that, right? In sane mind. Because there is countervailing and counter existing views in the market, that is why trading happens. Otherwise, trading will not happen. There is no need for any trading to happen. I have a view, you have a view. Our views are exactly opposite, is not the right word. We should say complementary. You and I, we have complementary viewpoints of a certain situation, and that is exactly where trading happens. One of us is going to win, definitely, for sure. One of us is going to win, and the opposite party is obviously going to lose. Sure, that is going to happen. But we have certain counteracting or countervailing views of a given situation. That is what hedging is all about, right? But inadvertently, we assumed that for everyone who wants to hedge, there is a suitable existing counterparty. Is this assumption valid? My question to all of you is this assumption valid? Is it a valid assumption?
Yes, yes.
See,
I don't
this,
know. I don't think so. It should be.
yeah, exactly. So this assumption is both yes and no. This is, I mean, if you say it is a valid assumption, well, it's your view. If you say it's not a valid assumption at all, you are still correct. Because it's obviously common sense, right? I should not expect that there is an existing counterparty of mine also simultaneously wanting to enter into the same contract, the opposite end of which I am standing. And that is exactly where the next player in the market comes into picture, who is a speculator. Who is a speculator? So please understand. See, we are learning derivatives from the very fundamentals, and you will enjoy this. Who is a speculator? The speculator, the first thing that you should attach with the speculator is, the speculator is the one who has no risk. That means the speculator has got nothing to hedge. Speculator has got nothing to hedge. But the speculator, even though he has nothing to hedge, has definitely a view. And that view is a counterproductive view to this hedger. In other words, speculators are the one that actually fill in the blanks. They are the one that provide the necessary liquidity to the market. Now you will see how the equation balances out. For example, suppose there are 100 hedgers. If there are 100 hedgers, and just take the farmer example, exporter, importer, whatever example. So ideally, against these 100 hedgers, you would expect another 100 hedgers with opposite view. Let's call this view A, and call this view B. So if there are 100 hedgers A, then there should be 100 hedgers B. Ideally, you should want this. But in reality, it is never going to be the case. Okay. It could so happen that 100 hedgers, there could only be 80 hedgers B or 70 hedgers. The rest of the 20 or 30 are the ones which are actually attributed to these speculators. Okay. Now, these are the one who do not have any specific risk to hedge. They have not entered the market to hedge any of the risk, but they have a view. They have a view to the market which is opposite of yours. What kind of view? So here, for example, if the farmer believes that the market can go down, the speculator believes no, market will go up. And he's cocksure about it. He's extremely sure about it on his viewpoint. And because he's sure about his viewpoint, he is ready to take the counterparty position of the hedger. Okay. So ideally speaking, what would happen? The speculator, if he wins, he will win. If he lose, he will lose. But the speculator at the end of the delivery contract will never have a zero position. Only a hedger can have a zero position. Precisely why? How many times you have heard in the market that people trade into options and say, today it was a bad day. I purchased 6 call options and then I lost all my money. I did not make any money. Do you hear these things among your friends? I traded into option contracts. I took some put options here, thinking market will go down. And market did not go down, and I lost all my money. I lost about 40,000 rupees today. Have you heard these things among your friends, families? Tell me candidly, have you heard or not?
Yeah.
You've heard this thing. What about you, Murli?
No, sir. Very few people are trading in options, sir.
Nowadays. So within quote, nowadays.
Yes.
During pandemic and after, till up to 2023, people were rampantly trading into options and they were losing money left, right, and center. Okay. Who are these people? They are the ones who are actually speculator. Normally, even if I have to trade into, let's say, option, what I do, I try to cover my position. There are mathematics that are involved. So cover my position would mean what? So for example, if I never carry an absolute view. I never say I'm 100% sure that the market is going to go up. No. I will say I'm 70% sure market will go up and 30% sure that market will perhaps come down given the volatility. So I will purchase 7 call options and perhaps 3 put options. And thus I will try to hedge my position. Okay. Somewhat hedging will happen here. Now, speculators exactly execute the same role as that of those novice traders in the market, but equating the novice traders to speculator is not the right thing. Speculation per se seems to be a bad word, but ideally speaking, the ones who do their homework correctly, okay, the ones who have intricate, deep knowledge, maybe some insider knowledge also, when they take positions, they make tons of money, tons of money. Okay, but then those creatures are in the market is around 0.1 to 0.2% in the market. And I'm definitely not one of them. Okay, let me tell you. Now, nevertheless, as far as the market is concerned, it is still good. Why? Because they are filling in those void. We just talked about, right? That 1:1 match, is it possible? Not every time it will be possible. There will be some gaps. So those gaps are being filled by speculator and as well as the arbitrator. Now, who are the arbitrators? Arbitrators are the one who spot something called as mispricing. Who spot something called as mispricing. How does that happen? Murli, can you explain? How does an arbitrator work?
Actually, they spot the price difference in the two different market and try to take cash on that, because buying in one market at a low price and selling in another
Absolutely.
market at a higher price. Yeah.
Absolutely. Absolutely. Absolutely correct. Okay. So when we talk about arbitrator, understand one thing. They are the ones who do not have any risk, and they are the one who will never take any risk also. Mind you, there is a difference. When we talked about speculator, the speculators did not have any existing risk. But mindless speculation obviously exposes them to tremendous amount of risk itself because they enter with an uncovered position, directional views, pure betting. Okay. But when we talk about arbitrator, the arbitrator feeds on mispricing. They don't have any risk to hedge, and via their position, they will also not be in the risk also. How does it happen? Let me explain through an example. Let's say a stock like Infosys. Okay. So what the Infosys stock is supposed to do? Infosys trades in the market in US. Infosys trades in the market in India as well. In India, suppose Infosys sells at, just giving an example, at 1200 bucks. Okay. If I say, just for brevity's example sake, if I say that rupee 100 is equal to $1, then I should say that in US market, the same Infosys share must be trading at $12, right? That's what we will say. I'm not counting those commission charges, etc., etc. Those things I'm discounting fully. Okay, I'm just purely focusing upon the price. So it is $12 versus 1200 bucks out here. So it's fairly priced, right? Now, suppose some reason the US market Infosys trades at $15. And in Indian market, let's say this from 1200, it is trading at 1300. And the exchange rate still remains same. Is there a profit opportunity out here, Murli?
Yes.
There is a profit opportunity out here. How?
Yeah. You can buy at 1,300 here and sell at $15 in US.
Absolutely, because $15 as per the exchange rate is equivalent to 1500 Indian rupees, right? So the same stock is selling in two different markets at two different prices, which gives an opportunity to the middleman or an arbitrator to make a clean sweep without taking any risk. He can simultaneously, it's just a click of a mouse. He just have to buy it here. He will press the buy button here and he will press the sell button here. It can happen simultaneously. In fact, in today's world, algos do the job. You don't have to physically do also. Algos will spot mispricing. If they spot mispricing, they will do the job. You will not even know. Algos are specifically built to scan through the prices worldwide for assets which are same or similar and trading at differential prices. If the algos are so written, if they spot differences, they will immediately make the killing. And the killing, please understand, it is just not about one share. It is just not about one share. If you see this price difference, can you imagine the scale at which it can be exploited? The scale is humongous because nobody is stopping me from taking position in 1000 stocks here because it is nothing for me, right? On one hand, I'm buying, and on the other hand, I'm selling. So there is actually speaking, virtually there is no cash out inflow or outflow from my end. I'm just the one who is actually skimming it. I can take position in 1000 such stocks, 10,000 such stocks, 1 lakh such stocks. In fact, all the markets that's there, I can actually sweep the whole market dry if I want to. Theoretically, that's possible. And make an immediate killing. Now, arbitration or arbitrators, they don't have these kind of opportunities every now and then. These opportunities are very rare, and in an efficient market, they're exploited immediately so that market returns to normalcy and no leftover arbitration is possible. That's how arbitrators want. But nevertheless, whether it is hedger, whether it is speculator, or whether it is arbitrator, all of these three players in the market provide the necessary liquidity to the market, capital market I'm talking about, not the OTC market, where actually derivatives can trade. So the rest of the chapter is all about the the other things which are there. I mean, I'll just walk you through because we have already gone through the major cream portion of it. Uh, Risk mitigation, different examples of ESOPs we talked about. Uh, I can also walk you through the call option or put option that are incorporated in bonds, but at this point it will become too complicated. Uh, Types of market where derivatives are actually traded. They're exchange traded market, standardized market, highly regulated, uh, minimum risk, mark to market, bid ask call, etc. OTC market are private contracts, non-regulated for most parts, customized contracts, total market size, etc. So let me just tell you a few things out here. What mostly derivatives that we are aware of, they are actually traded in the open market and they're known as the exchange traded contracts because they're traded on the contracts, organized contracts, the organized exchanges, that is your NSE, BSE, etc. Okay. On the other hand, the OTC markets are the one which are actually private markets. These markets do not exist in public. They exist privately. That means that there are two counterparties and these two counterparties actually draft a contract between themselves. Okay. But more often than not, these two counterparties will also have an intermediary. But this intermediary are actually bilaterally chosen. That means they are being chosen in consent uh, of both A and B. Out here, A and B will choose the party, and this centralized counterparty will execute all other necessary job that is required to do for executing for facilitating this contract, just like our exchange does. For example, we have this NSE exchange. So NSE exchange also, if you see, there are buyers and then there are sellers. Any derivative contracts, anything, whether it's an asset or derivative, there are buyers and then there are sellers. How the exchange works is that the exchange becomes seller to the buyer and become buyer to the seller. Okay, and then it works through something called as bid ask. Okay, because this is completely a transparent market, electronically settled market, and all of the things are mostly visible to us. That's how regulated market works, where the risk is basically minimal because the exchange has certain settling mechanism, which we call them mark-to-market mechanism. Mark-to-market mechanisms are the one that actually enables the market carry zero risk at the end of each trading day. How that happens, we'll come to it later on as we move ahead. But just know this, that this is how an exchange works. On the other hand, the centralized counterparty is somebody who actually stands between A and B and executes in the same fashion as that of any organized exchange. Okay. The rules are almost same, but they are highly customized and only pertaining to A and B only. Those are known as OTC market. The OTC market as of now, I mean, just to give you some perspective, the total world's GDP as on 2025 is around $118 trillion. Okay. The total derivatives markets, that is OTC, okay, that principal is around $850 trillion. Okay. The exchange traded market, on the other hand, that is the market that you and me we are aware of, and you and me we mostly trade in, is somewhere close to 130 to $140 trillion market. So you can imagine from here that those big banks, those big institutions, AMCs, institution funds, what is the size that they operate in? Okay. Obviously, the contracts are mostly customized, wherein in an exchange traded markets, contracts are completely standardized. Okay. Regulation will not apply in OTC market. Regulation will apply here. But the regulator keep a watch on the OTC contracts as well. Why? Because 2007, 2009, the subprime financial crisis, one of the major uh, aspect was that some of the OTC contracts found their way in the capital market by several means of financial engineering that happened. So the regulator needs to ensure that such kind of OTC contracts never should find directly or indirectly any sort of presence in the capital market. That is the market in which public actually trades in. Because if that happens, obviously public will lose any faith in the capital market. we are not that sophisticated like that of institutional traders or institutional players, right? So institutional players will have much more sophistication. They will have better systems. They will have better understanding, which obviously as retail investors, we would lack that. And the paramount job of any regulator is to ensure that the weakest in the capital market, that person's interest is protected. So to that extent, yes, regulator do not actually regulate any OTC contract, but they keep a watch on this. Precisely why every OTC contract will have to be nationally reported into something called as central registry. And every OTC contract is executed into something called as SEF or swap execution facility. Swap execution facility is a national board. Even India has it, US and other developed markets obviously have it, wherein these kind of derivative contracts that are OTC contracts that are being traded. But regulator keeps a watch on all of this so as to ensure that they do not spill over. And the intermediary that we were talking about, CCP full form is centralized counterparty. All right, so last bit of it, types of derivatives, linear and non-linear. I'll just explain in 1 minute that why something is called a linear and non-linear. So typically we understood that when you talk about, let's say, forward or future, uh, if somebody who is long to the forward contract, that means somebody who has contracted to buy at a certain price is said to be long to the contract. So if he wins, if the long wins, that means an equal loss for the short to the forward contract. Okay. That is why it is called a linear contract. That means the risk and reward ratio is always going to be 1:1. Okay. Just giving an example. Suppose you and me and Murli, we enter into a forward contract, wherein I say that Murli, I'm going to buy certain product from you at $150 1 year down the line. Okay. So 1 year down the line, suppose that particular product which I'm supposed to buy from Murli, that market price at that point in time, which we called as the spot price, becomes $200. Then what happens is I am definitely going to win $50. Why I'm going to win $50? Because I have contracted to buy at 150. That means I'll have to give Murli 150 and Murli have to make that thing available from the market. If Murli already has it, then he will have to give it to me at 150, right? Murli otherwise could have sold it in the market at 200, but because he's bound by the contract, he will have to sell it me at 150 only. Thus what happens? Indirectly, I'm gaining by $50 and Murli is losing equally $50. Okay, it is as simple as that. Now, this is an example of linear derivative. Same is the case with futures as well. We discuss at length. When we talk about those futures mechanism, how that happens. Okay, so in contrast, if you think of an option, remember I told you that option is a little bit different because in case of option, what happens? There is right and then there is obligation. Right is fully of buyer, obligation is fully of seller. Now, just to put an example, let's say we're talking about a call option. Okay, before that, let me again uh, extend this example once again. That this is where I said long wins if the spot price becomes 200 and the contracted price was 150. So obviously $50 is what I'm going to win as long to the contract. But just think of the opposite, that in the market actually tanked. So 1 year down the line, instead of $200, it became $100. In that case also, I will still have to buy this at 150 only from Murli. That means I could have bought it from the market at 100, but no, since I'm bound by this contract, I'll have to pay Murli 150 and Murli have to give it to me at 150, whatever product or whatever underlying that we are talking about. So in the process, what happens? Murli gains 50 rupees out of this. Okay, so what we say in this case, if the price goes up, the long wins. If the price goes down, the short wins. But in either of these cases, whatever long gains is exactly equal to the loss the short makes when the price goes up. And whenever the price goes down, whatever loss long makes is exactly the gain the short will be having. It is exactly clear from this example. There is nothing more or nothing less to it. Precisely the reason that the risk to reward ratio always remain 1:1 and hence they are called linear derivative. But in contrast, let's just take a quick look at the option contract. In option contract, what did we say? That the long to the contract has all the rights and no obligation. Short to the contract, that is the option seller, has all the right, all the obligation, but no right at all. How does this happen? This happens because of a trade, and the trade is at day zero. The long must pay the short, that is the option buyer, must pay the option seller the necessary premium. Once he pays the premium, he purchases all the existing right of the shorts. The short does not have any right anymore. He will just have to pray that the market should not go otherwise. Market should remain in my favor. It should not go otherwise. Let's just take an example. Suppose we are talking about call option. Okay. So in case of call option, what happens? You would know already that if the price of the underlying goes up, the long is going to win. That is what call option is all about. Because when the price of the underlying goes up, the long is going to exercise the call option contract and obviously make the money. Okay. So for example, let's just take an example that the long bets on a stock which is currently trading at $100. The long thinks that the market is going to go up. So long accordingly pays the short to the contract to purchase and call option of, let's say, $10. And indeed, 1 year down the line, 1 year down the line, three things can happen. One of the three things can happen. What are those three things? Let us see. The market can either go up, the market can remain as it is, or the market can come down. Only these three possibilities are there. Let's first discuss the bottom two. Let's say 1 year down the line, the price of this underlying remains at 100. In this case, what happens? The call option writer, that means who sold the call option through the long buyer, he will get to keep the $10 premium and will have not to make any payoff at all. So the short is happy, right? Because the price has remained at 100, which was the strike price. Second, suppose the market comes down. If the market comes down and suppose now it becomes 90, then also the short to the contract is happy. Why? Because the price did not go up, so he does not have to pay anything. He still will get to keep the premium. Now let's think about the last possibility. And the last possibility is when the price actually goes from 100 to, let's say, 120. If the price goes to 120, at this particular point in time, the short to the contract is going to have a tough time. Why? Because he will have to now make a payment of 120 minus 100, that is 20. And he had collected $10 initially. That means his loss overall is going to be $10. But just this is not the end of it. Theoretically, this 120 can actually could have become 130, 140, 150, or even 200, whatever. Sky is the limit, isn't it? In each of this situation, his premium of $10 would have remained $10, but his payoff would have gone tremendously high, right? So clearly we can understand that in this case, the risk reward ratio of 1:1 is not maintained, isn't it? Because of the obligation of the short, the risk reward ratio is definitely not 1:1. It is 1:many. That means against $10, he can incur a loss of $10. Against $10, he can incur a loss of 20, 30, 40, 50, $100. Okay. Precisely because of this, the option is said to be a non-linear derivative. Now, your book does not explain this, I know. Book will, I mean, whether you study those through those third-party prep providers or your GARC curriculum, they will have some flimsy way of explaining the difference between linear and non-linear. And more often than not, that will not make any sense. But this is the crux of the matter. That why forward futures are called linear, because the risk-reward ratio is always 1:1. But the options are said to be non-linear because the risk-reward ratio is not 1:1, not necessarily 1:1. These are some of the graphs. I don't think I need to talk. We have already talked about hedgers, speculators, arbitrators, etc. risks in derivatives. Why derivatives? Specifically for speculators, hedgers, we know that why they have the reason, compelling reason of actually entering into derivatives contract. But speculators, on the other hand, they obviously enter into the market because of mispricing and because it gives them leverage. Remember, I told you that if there is a good speculator, which are basically uh, vanishing species, where they're actually rare breed. So they make tons of money because of something called as leverage. I'll explain what that leverage is all about. It's not very difficult to understand. So, for example, I'll just give you. Let's say you have $10,000 with you. Okay, and there is, let's say, Apple stock, which is trading in the market, and Apple is priced, let's say, $200 a piece. Okay, so with $10,000, if you purchase the whole $10,000 of Apple stock, how many stocks can you purchase? You can purchase 50 numbers of stock. It is very easy for us to understand. Let's also assume that there are call options that are there in the market of Apple stock. Okay. And those call options are priced, let's say each of them are priced at $20. Okay. So it is easy for you to understand that if I invest the entire 10,000, then I can get 500 shares, number of call options. Okay. Now let's hypothetically see a scenario that these call options are valid for 6 months. That is, the life of the call options are for 6 months. Remember, one of the principles of derivatives is that they have defined timelines. So 6 months down the line, again, one of the three possibilities is there. Either the Apple stock can go up, it can remain at its place, or it can come down. Only one of the three is there. Evidently, without explaining much, you can understand that in these two scenarios, your call option is not going to get you any payoff. Okay, let's talk about the third scenario. And in the third scenario, let's say the Apple stock, because of the AI revolution that is happening, Apple comes out with some sort of AI product in the market, etc. And that, because of that, the Apple stock skyrockets to, let's say, $350 a share. Okay. So in this case, let's see, in both of these cases, what happens? If you had owned the Apple stock all along, then what would have happened? On 50 stocks that you would have owned, you would have made money 50 into 350 minus 200. How much money you would have made? 7,500, right? So on your investment of $10,000, you would have made $7,500 of net profit. So that means your return in 6 months would have been in Apple stock 75%. Now let's see what happens with your call option. In this call option, what would have happened? Because the stock is same, right? So the stock is 350 minus 200, but this time around, instead of 50 numbers, you have 500 numbers, right? Which will become 75,000 rupees, $75,000. Okay. $75,000 on an investment of $10,000 in call options would have given you a return of now 750%. This is what is known as leverage. Okay. But leverage is a double-edged sword. Please also understand this. How? Because if the calculations were not right, if the anticipation went wrong, if the analysis went wrong, or something out of the bound happened in the market, because of which the Apple stock plummets from 200 to, let's say, 150. In this case, this person who had owned the Apple stock would have got a loss of $50 per share, and with 50 number of shares, his loss would have been $22,500, right? So on an investment of $10,000, his loss would have been 25%, right? We are talking about this scenario where it comes down. But in this case, the investor who purely only speculated on the call option of Apple and gambled his entire $10,000, he would have lost his entire premium. That means his loss would have been 100%. Okay. Now, there is one more thing. Remember, we said in any derivative, you cannot have any ownership, right? So in this case, what would have happened? Not only that you would lose this $10,000 completely, you have got nothing to do with the Apple stock after 6 months. But in the former who had purchased this Apple stock, even though in the 6 months he had incurred a loss of 25%, he still will be owning these 50 numbers of Apple stock, which has a potential again go up sometime in future. Okay. This is one of the primary differences of asset ownership versus derivative fractional ownerships. Okay. And reason why that 99.999% speculators, they ultimately lose everything in the market. All right. So one example we will just solve just to, get hold of the thing, how arbitration actually works. There is a derivatives trader, and he is trading copper market. Spot price has been given as 1500. 1 year risk-free rate of return is 6%, and 1 year forward contract in the market is rolling at 1700. A fixed storage cost is also being stated for 10 quintal, 100. We are saying if Timothy can create any arbitrage opportunity. Okay, there can be one of the two arbitrage opportunities. One is called cash and carry arbitrage, and this is called reverse cash and carry arbitrage. Now, these terminologies are no longer used in your FRM curriculum. They simply call it arbitrage. Now, let's see what happens. So, current spot price is 1500 per quintal. So, 1 year risk-free rate is 6%. Now, let's see. I'm not even getting into any formula. We'll solve it through common sense only. Okay, just pay attention 5 minutes and it will be over. So this 1500 stock price, this copper market which is there, 1 year forward contract is already there in the market, and that is selling at 1700. This is the problem which is in front of us. And we are being said that please spot if there is any arbitrage opportunity. And if it is there, how to cash that. All right. So let's see. First and foremost is, how do we price this forward contract, right? What is the common sense? What does the common sense tell? So the common sense will tell us that, boss, one of the ways of actually thinking that how a forward contract or any forward contract or futures contract should be priced is to first observe something called as a spot price. Okay. And then imagine if this spot price is being kept in bank. Okay. What the bank would have given. If it is readily traded in the market, the bank would say, well, if you put this, I'll give you 6%. Okay. Let's assume a very ideal scenario wherein the bank does not have any spread. That means bank does not make any interest income out of whether lending or borrowing. It does not make. Okay, that means somebody comes and parks money, he gets 6%. Somebody asks to borrow, he also gets 6%. Let's just assume, I'm just making certain whimsical assumption just to drive home the point. Okay, just to tell you that how actually forwards are actually priced. There is a equation that's there, which all of you might have seen before. That this is how forwards are priced. But I'm getting into the mechanics of why this is so. Okay, so if you go and say that, boss, I'm keeping this asset with you, loan against share, loan against an asset. How much you're going to give me? The bank says 6%. Conversely, a person comes and says that, boss, I have to buy something from the market for which I want to borrow money. How much money I am to borrow? I want to borrow 1500. How much I have to pay you? How much I have to pay you? Bank says 6%. Bank says 6%. Now imagine, you guys have worked in bank, you would know that, there's something called a loan against share, loan against property, etc. Yes, there is a haircut, then there is margin, etc. Those things are there. Let's not get into those complications as of now. Let's build the intuition first. So the basic things out here would make us think that, okay, in either of these cases, that means a no arbitrage. Mark my word, what I'm saying. A no arbitrage fair price. So let me write it. A arbitrage, no arbitrage fair price, no arbitrage fair price would be, in that case, 1500 multiplied by 1 plus 6%. If I keep it for 1 year, then it is to the power 1. It is as simple as keeping 100 bucks in your bank at the rate of 6%. Because if you keep 100 rupees in your bank, the bank is going to give you 106 rupees at the end of 1 year. Exactly the same thing. I'm just done it here. Simple. That means at the end of 1 year, this should be around 1590. 1590. This should be the price. Price in future, 1 year down the line. Okay. The keyword is not this calculation. The keyword is this one. No arbitrage fair price. Now you would say, why this no arbitrage fair price came into picture? Because suppose I'm having an asset. Forget about this commodity. I'm having an asset. I have a bike. I want to sell, this is a vintage bike. I want to sell this bike 1 year down the line. I have some emotional attachment. If that bike is today priced at, let's say, 1 lakh rupees, I would say 1 year down the line, it will fetch me maybe 1.2 lakhs. Why? Because this has vintage value. This is 1950s bike. It has vintage value. I'll not consider depreciation. I have too much emotional attachment. People are crazy for vintage bikes like 1950s Bullet. So I'm going to sell it at 120. That means 20% appreciation. The seller, on the other hand, says he would want, this is the seller. So the buyer, on the other hand, would like to buy it at the least price. The buyer will say, Are 1 year down the line, you are going to, in fact, it is going to depreciate. You should sell me at 90,000. Why 1 lakh? Why 1,20,000? Now imagine if there is a middleman. What the middleman will say? The middleman will say that, boss, if your asset is traded in the market, you as a holder of the asset will have very positive view. You as a future buyer of the asset you will try to buy it at a lesser price, as much lesser price as possible. A seller would want to sell it as high as possible. A buyer would want to sell it, buy it at as low as possible. Can we agree that an asset which we are designating as a risky asset, an asset that is designated as a risky asset, must at least return the risk-free rate of return? Assuming the risk-free rate is 6%, which is mostly the bank rate, because otherwise it makes no sense. Because if an asset does not even yield the risk-free rate of 6%, why the hell I should be actually be interested in that asset? Buyer will say, okay, fine. Seller will say, reluctantly maybe, okay, fine. But at least a position will be created from where a trade can happen. Precisely one of the reasons that why forwards are actually priced in this manner. Forwards or futures are priced in this manner. Their logic and argument is that an asset which at least should yield the bank rate, some derivative contract can be written on this, because the other viewpoints can be too extreme. I can have a fantastic viewpoint. I will say my asset is going to give me 30% return. Somebody will say, no, yours is a very risky market here. It can only, who says market, it can give me a negative 20% return also. But none of them will disagree on this logic. Precisely why the forwards are priced in this manner. Now, coming back to this problem. So we see that the fair price of this spot should be around 1590. But there is one more problem. And the one more problem is that there is some storage cost also, which is there. Where the storage cost comes from, because there is a commodity you will have to store. And it says that it's a fixed storage cost of $100 for 10 quintal. Roughly, if I do a math, so that means 100 divided by 10. I'm just doing it for 1 quintal basis. That means $10 is the storage cost per quintal. So somebody who is investing, he will also incur cost of $10 because $10 will have to be borrowed from the bank, right? So $10 also has a cost. $10 also has a cost. How much that cost is? Same. Again, at the same percent we will continue. Because remember, at the beginning I said, in an ideal market, I'm saying the buyer can borrow at the rate of risk-free rate. The seller can park the money at the rate of risk-free rate. There are no transaction costs. There is no tax. Bank takes no margin. It's an ideal scenario kind of thing, which we are saying. Later on, as we study forward futures better, I'll tell you also the limitations of such assumptions. Anyway, so this becomes, so $10 for 1 year, that price becomes $10, $10.6. That means the total cost is 1590 plus 10.6 or 1606 cents. This is what is known as the fair price of the forward. Fair price of the forward. That means the forward should be priced 1600.6 in the market as on date. But for some reason, maybe because of demand, maybe because of mispricing, the forward is actually selling at 1700. Now tell me what Timothy can do. You have guessed it right. He will sell this forward because it is priced high, right? He will sell this forward at 1700. Sell this forward at 1700 and hoping that the price at the end of it will drop to 1600, because what will happen is if I sell this forward at 1700, immediately I will buy also at 1500. So I buy at 1500 from the spot market. Understand how the arbitrage works here. He will buy at time T0 from the open market at 1500. He's buying the spot. At 1500, he will buy. He will incur this storage cost of 10.6 per dollar also. No problem. But he has his position completely covered. He will not have to buy it from the market anymore. He will have position this covered. And at the same time, he would enter into this contract as a short to the contract. That means he wants to sell this. At 1 year down the line, the buyer will make him a payment of 1700 because this is a contractual obligation. It's a contractual obligation. He will return the bank 1500 and he will return the bank this 1600.6 because he has borrowed money from the bank to purchase this asset. So he will return the bank 1600.6 and then pocket the rest of it, which is close to about $100, close to $99.4. This is what is known as a cash and carry arbitrage. How this cash and carry arbitrage came into being? Because of few things rather. First is the arbitrator spots the mispricing. Mispricing must be spotted first. Okay, he spots the mispricing. Second, he calculates the fair value. Third, he notices the difference. Fourth, he takes the opposite position. Sometimes it says takes the offsetting position. And last, he closes the position at the end of the contract. These are the steps of mispricing. What was the mispricing? The mispricing was that he said he saw it trading at 1700. The ideal price of which should have been 1600.6. So he spot this mispricing. Okay. So the fair value should have been 1600. I'm just rounding it up. And it was selling at 1700. He immediately spots this mispricing. What was the difference? The difference he could calculate was a 100. Then what did he do? He takes the opposite position. Opposite position means always, in case of arbitrage, buy low, sell high, buy low, sell high. Never forget this. As simple as that. So he immediately entered into a forward contract as a seller to the contract. So he sold the contract. That means he shorted the forward contract at 1700, borrowed this 1500 rupees from the bank and the 10 rupees from the bank. So he borrowed 1510 rupees from the bank to purchase the asset, the spot he have wanted to purchase. So he purchased the spot. In this case, this is copper at 1510. 1500 for the spot and 10 rupees, $10 for the storage cost. The bank charged him interest of 6%, which became 90 point whatever 1510 to 16. So around $90.6 was the interest. So at the end of the contract, what happened 1 year down the line, he collected this 1700, paid the bank its due, that is 1600.6, and pocketed the rest of $99.4. When you understand in this manner, I could have solved this problem through some idiotic formula. You would have not have understood. When you solve in this manner, derivatives is 1, 2, 3, as simple as that. So I stop my presentation here. Rest of the things are pretty some examples, etc. there. I will share this. Don't worry about it. I'll share this with all of you in case you want to go through them. Let me know if you have any questions, else I will close it for the day. Chetan joined us late. Chetan? All right. Thank you, everybody. Hope to see you soon.